everything is digital, right? For them, it is digital native, and you can forecast like what will come when the next generation takes over.
Money isn't just some numbers on a screen. It's trust. It's discipline.
India does not have a very structured pension plan. So shift to financial assets can safeguard people.
Whether you talk about large caps, mid caps, small caps, there's opportunity everywhere.
The economy will base itself on these 4 pillars.
What's the bigger challenge? Making money or keeping it growing year on year? Money isn't just some numbers on a screen. It's trust. It's discipline. Sometimes euphoria, and certainly sometimes fear. My 2 guests on the show have seen a spectrum of this financial journey and helped shape the investing journeys of millions of Indians. Well, my first guest needs no introduction. वो मेरे शब्दों के मोहताज नहीं है. But all I can say is that he is one individual who's helped the meteoric rise of his organization and morphed the house into one of the most formidable fund houses in the country and stands tall amongst the most financial astute voices in our country. Swarup Mohanty, ladies and gentlemen, is the Vice Chairman and a CEO of Mirae Asset Mutual Fund. And joining him is a guest on the show, Gaurav Seth, the MD and CEO of 5paisa, who works at the intersection of tech and finance, shaping how India invests and making it more accessible. Now, these 2 gentlemen will talk about not just the markets, but the human dream, the dream to grow. Because behind every SIP, every portfolio, lies a human dream, the dream to grow. Let's dive in. And I'm your host, Hardik Vaidya, and welcome to the Smart Money Show. Welcome, gentlemen. It's a pleasure to have you.
Thank you so much for having us, really.
I want to jump right into the meat of the conversation because there is so much to unpack. Swarup, thank you for making the time. First up, what has been the most transformative impact that you've seen in the way India invests in mutual fund across the start where Mutual Fund Sahi Hai campaign started to now?
So I think the realization of investing was kicked off, if I dare say, during demonetization. A lot changed for us then. And the final kickoff started post-COVID. It did also coincide for us selfishly as an industry from the Mutual Fund Sahi Hai campaign, which took the mutual fund to every household in the country. The first slide we would do in any presentation is what is a mutual fund. Now that is not there anymore. People know what is a mutual fund, the virtues of mutual fund, and more important, disciplined way of investing through SIP is something which has come about. We are beginning to see a dramatic shift from fixed assets to financial assets. And I feel mutual funds are at the forefront of that shift to financial assets. And it will do a lot of good to a country of such a large proportion. Because please understand, in this divide of rich and the rest, a pension plan sort of safeguards people. India does not have a very structured pension plan. So shift to financial assets can safeguard people for their future. And I think mutual funds have really driven that to the last mile of people who have shifted. Yes, the number of people who can shift is dramatically high, and work in progress on that one.
So this is a very interesting time where 3 generations are actually investing together.
True.
With 3 very different patterns.
Yes.
Could you shed some light on that?
No, I think when you look at that, and very rightly said, in my 30 years of working, typically my father and I have invested. The addition of the son changes everything. Please remember that 60% of world population under 30 resides in this country. So when you look at the proportion of that, and you look at the next, say, the industry today is at, say, 5.5 crore unique folios. In the next 5.5 crores composition will be more than this, and that changes everything. So when you look at the journey so far, 25, 30 years of the mutual fund industry, because of that demography adding, the next 30 years may not have any correlation with this 30 years. That is the interesting phase we are standing at.
You've seen a shift in terms of how India invests with the platform being so tech forward. What are some observations that you've seen across the 3 generations that are investing on the platform?
So I'll just go back to the earlier question. About mutual fund Sahi Hai. So mutual fund Sahi Hai, I think what it has done fantastically is now it is considered like the basic vehicle for investing with increasing financialization. So that's it. Nobody even asks the question that, what is a mutual fund, like as Swarup was alluding to earlier. So that is one. Second is the fact that we are moving a lot from fixed assets which is real estate and some of the others, to increasing financialization of assets. So again, the primary vehicle that anybody thinks about today is mutual funds. So I think the industry has come a long way. So having said that, I think from a digital platform perspective, we have this notion that the older cohort is not digitally savvy. But I have actually seen, is my personal experience, I want to make this confession, I don't use like Siri and some of these voice bots, right? And privacy and this and that. So we think too much. But the adoption, you would see car drivers using that, and I've seen it globally. So across the three generations, I think even the older generation is now started to be very digitally savvy. And for them, they're asking the question whether it is that generation, whether it is a generation who's under 30, which are anyway digitally native. So any other form of way of investing or doing any transaction to them is alien, because I do my payments online, I do my shopping online, I book my food delivery, I book my dining table. I mean, when I go out, everything is digital, right? For them it is digital native, and you can forecast like what will come when the next generation takes over. So I think digital to me is the way to go, and there's rapid adoption which is happening and across all three generations, in so to say.
But then DIY investing has become like a major trend. Yes. Is it detrimental to each of your platforms as a business?
No, not at all. I think DIY is here to stay, and it really depends on where you are in your life and what are your goals and what are you trying to do, what are you trying to achieve, right? And I've always said that like a financial advisor or a helping hand always helps if you have a more complex situation. But at the end of the day, that is just to help you still do DIY. Maybe you get your advice in an offline manner as and when required. Even in some cases, that is not required. Let's say if I'm a seasoned individual, and I think when we were having this offline conversation, we talked about this whole that all of this data is there for you to see. Everything is at your disposal. So any reasonable-minded person will do the research, and it behooves him to move in that direction. But when your situation gets a little more complex, there are tax issues, there can be multiple things where you require that support. But DIY, I would say, is not detrimental, it's actually very, very beneficial to whether it is a distributor or whether it is a fund house or any other player in the industry.
I think each to his own, right? The word is personal finance. That means everybody's personal life is different, so everybody's behavior towards finance will be different, right? If I look at the young and I go back to my young days, I would have definitely backed myself to do it on my own, and people should. Of course, the information that was available when I was young to what it is available now is phenomenally high. So if one was to back oneself to decipher that information and come to some logical questions or answers, I would definitely advocate that. Whether it's mutual funds or stocks, more for stocks than mutual funds, if you ask my honest opinion. But if you want to lead your own life and structure this to a professional, whether it comes to a fund manager or to a distributor advisor, that also is there for you. I mean, why do you want to get into this complicated world? Because out of so many stocks, you have to come to, after a lot of learning and a lot of time, you come to a conclusion. The fund manager takes a lot of time to come to a stock. If you want to do that, be my guest. But if you don't, then there are professionals in the market. In that, my only thing is, don't think this is a return generation business. It is a business to aid your life. The sooner you get your portfolio to help your life, the better for you. I mean, if you approach investing that way, it will do you a lot of good.
You mentioned that you were talking about your early days. When did you actually start investing?
Oh, I started, I can give enough excuses for not starting early. That was the biggest mistake. But towards 2000 is when we started investing. I think towards the late 90s, we were all fixed deposit investors and life insurance investors. We used to call ourselves life insurance investors. But sooner or later, we came to know what was right, what was wrong. But capital market investing started in 2000. A serious investor, after my son was born.
So, Swarup, what changed after the birth of his son?
No, I think on a hindsight, it's very easy to know all this. But typically, you are told that marriage changes your life. I don't think marriage changes anything. It's the birth of the child which brings a certain amount of responsibility in you. I think that dawned that, you have to cater to him more than you. So that probably was one trigger. The other trigger, which is very interesting, is that earlier you were this return chaser, but post 40, I could hold my allocation, and so it's not easy to invest. But I think that was my first trigger. The second trigger was post 40. So these two were very important triggers from an investing perspective.
Interesting. Did anything shift for you? Were there any benchmarks, any timelines that shifted and made you a serious investor?
Yes. So back when I was in the US, I was working, and then 2008 financial crisis. I was very negative, or I would say pessimistic. And 2009 onwards, people, some people stayed out of the market. A lot of people came back into the market, and there was a lot of opportunity almost from 2009 to 2012 to get back into the market. And I was like, maybe not the right time. Why stocks are lower? They might go lower, etc. So I missed the bus. And I started seriously investing around 2015, 2016. So, and then from 2016, I've held on to them even now, sitting in India, and I think they've done phenomenally well from there. So that was a big learning for me, and that's what shifted. That you have to invest. I mean, take your call, have your style, but typically, if you can be in a position where you can hold your stocks for the long haul and maybe never sell at all, as Warren Buffett says, that is the perfect thing. So that's what shifted in me. Then I thought that, I've learned my lesson. Markets are there, will go down, go up, but you have to really start sometime.
I think the mistake many of us made in 2008, thankfully I didn't repeat during COVID. I mean, when COVID, we were ready. Market tanks, you buy, and you practically sold your house to buy in COVID. But that's not what we did in 2008. Risk profiles were very different. Our knowledge of risk was very different. So yeah, you go through those phases, which are very interesting.
And I think it's very interesting. Wisdom prevails once you go through certain crises.
True. Nothing happens till it does not happen to you. It happens to you, then you learn.
Well, we talk about, and viewers are watching this video, and let's say there's someone who's a retail investor and they know that this is India's decade.
Correct.
How should they position themselves?
See, knowing, believing, and internalizing are three different things. You can know. Like, I'll be very honest, I knew gold would do well. There were enough podcasts where I've given a call on gold, but I didn't implement it in my portfolio. It's a big miss. I can't explain why. There was allocation, but it's such a strong call, then you don't take call on, maybe, I can't give an excuse, right? Similarly, knowing that this is the India's decade, there is absolutely no country which does not believe that India is the growth country. There is secular belief in this. So once you know, you have to believe. If you believe, then you internalize, right? Once you internalize, then you have to, that internalization has to take form in the portfolio. If your economy is going from say 4 trillion to 8 trillion or say 5 trillion to 10 trillion, this entire country will be rebuilt. This growth, one of the best ways to get that growth into your personal life is through the capital markets. The best way to form it. It's very easy. So you just buy. And the best way of making good wealth out of any good asset is when you hold. If you know it's a decade, buy and hold. As simple as that. People who hold will make money. People who try to figure out the best 2 years out of these 10 years will be on the fence.
It might be as simple as that, but definitely not easy.
No, it is not easy, but it is as simple as that. You see, the biggest thing Gaurav talked about, Warren Buffett, is the only fund manager globally who's held on. See, in mutual funds, only two people make money. One, who has lost his or her account statement, and second, data says who are dead. There is nobody else who makes money because you don't hold. People, and I'm writing an article about it, probably you'll read it when it comes out. People in India are suited more to make wealth in gold than in equity. Because in gold you hold. It's as simple as that. It's a great asset, good asset class called equity. The only people who will make it, and if you're trying to predict, see, as a fund manager, our job is to find out 50 or 60 great promoters and build that portfolio, another 50, 60. Then the job is to take the journey with them. If you ask the promoter, is this the best time of your stock? They will not know because they are trying to create a better business.
Absolutely.
And you have to have that belief that someday that unlocking of that value will come to you. Which day, if I knew I wouldn't be a salaried individual, none of the fund managers would be salaried individuals. But you have to have the will to. You're already, an average Indian is already demonstrating it in gold, already demonstrating it in real estate.
So this seems to be like this one major learning for you. I think across the past maybe 5,
Hold.
6 years,
Yes,
10 years.
hold. Like the same thing that's come about is if you bought in 2016, you're holding now, you make money. If you know 10 years is the great year for India, then look at it from the 11th year perspective. But 10 years, so you have to sit. And it's not difficult to sit.
Gaurav, what's your take on this?
I mean, perfectly put by Swarup. But I think I'll go back to the psychological conditioner, and I'm a victim of the same thing. So it's knowledge is something which is knowledge, right? You can watch this podcast and say, oh, what great words by Swarup, but you actually go and implement it. That's the discipline, right? So knowledge and then understanding, internalizing, and actually finally taking action. That is where the gap is. There is no secret sauce for that. It's just building your discipline, what you're comfortable with. But as a general rule, I would say if you believe in the next even decade and a half for India growth story, you should be seriously be in equities. I think the way to be more comfortable with yourself is that, okay, if I'm a little bit of a conservative individual, I'm a salaried, I'm in my 20s, for example, save a good amount, and allocation could be anywhere, like depending on 50%, 70%, whatever you're comfortable with, right? But leave something on the table for you that like some drawdown comes, some bad years come, so you're not like, oh, everything is there, and then you take stupid decisions. So figure out what your comfort is, keep that aside, and I think equities is the way to go. I would strongly recommend for.
I mean, I'll just take on that. Earlier when in our younger days, stock prices would be available next day in the papers, or if you were a stockbroker. Yeah. When the business channels came, the ticker started appearing. That's when people started knowing what is the stock price. At that point of time, a fund manager had told me, "Paisa laga. Just watching the ticker is not going to make you money." So you have to be invested in the market to enjoy this journey called India.
So, dear viewers, if you're watching this episode, please ensure that you do participate and actually take action on the conversation that we're having right now. We'll jump into the other bit where we talk about small cap and mid cap. Now, this is, I think, an area which you really love and also an area that you admire a lot in terms of wealth. Why is there panic sell? Why is there people expect volatility from small cap, but what happens? What behavior change happens that people sell or they don't stick with it for the long term?
I think it is a graduation of your journey as an investor, and all of us have gone through that, right? At the beginning of my career and when I used to invest, I was trying to time the market because by virtue of being in this trade, you feel you know the market, but slowly but surely it dawns on to you that the market is smarter than you, right? But volatility can do things to your mind till you don't graduate to the learning that volatility is your best friend. And in volatility lies your opportunity. That graduation does not happen. And trust me, the graduation happens for a few. That is why that many few people make money in the market. There's this great Carl Richards slide, investment return versus investor return. Stock markets are making money, NAVs are growing, but you want to participate for a short time on that NAV. That does not work, right? And it comes with time, very honestly. And when the most volatile part is the small cap part, it tests you. That is why the virtues of asset allocation, and you should invest as much as you can sort of fathom or your risk profile allows. Again, knowing your risk profile is a journey. What I was before marriage, what I was after my son, what I am now when I am accumulating for my retirement are three different stages of my life. What I was when I was funding my son's education was very different, right? So portfolios are different. I give this very classic example since you're talking small caps. Till recently, between me and my mom is a retired professor. Who do you think invests in small caps? I'll give you the clue. She has pension. I don't have pension. When my portfolio return is 11-12% and I don't want downside risk, till recently, I was not investing in small caps, but she has pension, so she's free to do whatever she wants. Does not make her a better investor or me an inferior investor. But I know what I want. Coming to that stage of knowing what you want takes some time. And so we will all go through that. Between small cap and mid cap, yes, I'm in print saying that India is a mid cap company. So I'm a big fan of mid cap investing. So it's the best zone for stocks in India. And trust me, there are extremely qualified, pedigreed mid-cap managers in the country, a host of them. So you have a choice. And these are companies which are not exactly small. They've built themselves and are ready for the big boys. It's a great zone to be. And you hold them for 10, 15, 20 years, a lot of magic can happen to your portfolio.
Very
but holding
is the key word to focus on. Gaurav, what's your take on this?
So I would corroborate the same. See, whether you talk about large caps, mid caps, small caps, there's opportunity everywhere. Typically, a small cap or a mid cap, has to have a longer holding period. So you have to be comfortable with that. Now, question is, right? It could be 7 years, it could be 10 years for some of these companies. But the question is, how do you get comfortable? So I come back to the earlier point, and the way to be comfortable is understanding yourself psychologically. There are some people who bet the house, 90% they'll put on something and they're still fine, they can sleep. A lot of people, if it goes beyond like 50% or even lower, may not be that comfortable. So you have to really understand, and that comes with experience and age, and you hopefully start to get better. So you have first thing is to participate. I think that is number one plain vanilla thing. If you've not done anything, go buy an index fund, the safest investment possible. Participate, learn, then start to understand your risk profile, start to understand your situation. Like Swarup said, like funding your son's education. That time you might want more liquidity and don't want to take a risk. So be it. But some part of it is always in the market, right? So that's the way you go. As far as mid caps and small caps are concerned, there is opportunity and there is risks. Not all small caps will become mid caps. Not all mid caps will become large caps. So obviously, mutual funds, again, very qualified vehicles to ride the boom so that you are not personally taking those decisions and you leave it to professionals. This is a space which is best left to professionals. So, taking an allocation in one of these funds, I would say, is the best.
So I think that is very key. As you grow down market cap, the skills required to choose become higher. So there I would definitely second what Gaurav said. At those areas, it's better to come to a professional. Now, the other part is not to paint the brush in this thing. Large cap, mid cap, small cap are classified into two caps actually. Good cap, bad cap. And the number of bad caps are more as you go down market caps. How you get out of bad caps and get into good caps, if you have the knowledge, do it. It's easier to do it with the largest space. But as you go down, I think professional help. Since we discussed DIY, at that, sometimes the past returns are very luring. And if you just convert to a simple formula of allocating inversely to near-term return, a lot can happen.
I want to circle back to one of the points that you alluded to, both of you, in fact, something about risk and something about salary.
Correct.
But there is a very large portion of Gen Z millennials who are increasingly becoming entrepreneurs, founders, freelancers, creators. Well, incomes are inconsistent. Sometimes there's a windfall. There are some very, very lean periods. How do you capture that part of the economy, which is increasingly wanting to build wealth, but don't know how to go about it? Or are there instruments in mutual funds as well that you could potentially create, considering today's market? Are there funds that cater to the Gen Z millennials? What's your thought on this?
So I think two parts. One is the realization that one has to create wealth is most important. The need for investing then generates everything. Broadly, when you start earning money, you tend to cater to fulfill your aspirations than your need. But your need is investing, and that is paramount. Now, for investing, typically there's this whole thing of when to invest. For me, the best time to invest is when you have the money. The best time to redeem is when you need the money, right? And how much ever you might, if you Google a bit, they'll tell you timing the market is futile. And if you apply that to yourself, whether your income is lump sum, staggered, or in windfalls, you can simplify it. We also have, from our salary perspective, there is a salary, and most of us get a kind of a lump sum if you've done well in that year in the form of bonuses. That day you just go and buy it rather than trying to time the market or do whatever. It takes some time, I keep on repeating, to come to that stage. But if your asset allocation is in place, then as per your asset allocation, you just go and buy. Try to simplify as much as possible. But the more mathematical you make it, the less emotional you make it, the more wealth you make. Right? That's what this business is. I mean, again, referring to Warren Buffett, he is the least emotional when it comes to investing. And that's why somewhere we did discuss the index. The index is a mathematical tool. It cuts out all subjectivity. And over a period of time, a rule-based investing comes with its huge merit. So I think, one, if you are investing, you should definitely know the need for it. Because my personal take is you're going to live longer. And that age, the only friend is money. Irrespective of whether you're married, non-married, whatever, you need money. So start as early as possible. Build a plan for yourself. You can't go to a professional, and then ruthlessly just follow the plan. flow of money is secondary. Committing to the plan is most important.
Very interesting. Gaurav, you've been a founder as well briefly. Have you felt challenges like these that I'm alluding to right now?
Yeah, certainly, and there's a large cohort of individuals now who are very aspirational and doing wonderful things, and they would have a lean patch. Even when you are a well-to-do founder, you have some savings in the bank, and then you started a company and you're waiting for funding, etc., etc. You're committing your own capital and so on and so forth, right? So, I think the fundamentals remain the same. The whole thing around should I do SIP versus should I do lump sum? So, question is that, look, if I don't have a cash flow, let's say from July to September or July to next January, what do? I don't have money for SIP. So that is a fundamental question. So, okay, that's fine. If you don't have money, if you have money in the bank and you can do your SIPs, do it. If the situation is such that you're really tight on liquidity, don't do it. But when the lump sum arrives, right, or when you've got your bonus or your business has taken off, invest at that point in time. And if you really want to make sure that like you're averaging out, let's say you have $1,000. So you put 1,000 and then you put like SIP for that, like start to do like a systematic investment into the market for the next 6 months or next 1 year. You could 100 over the next 10 months, and you potentially get the same. But finally, you realize that there is whether a lump sum, SIP, it doesn't matter. It's like just whenever you have money, just do it. It's that simple as that. I tell that to myself. I have some money lying in the bank. I have not invested, so I'll give you personally not large chunk of fixed deposit coming off from my wife. It's lying in the bank, earning 6%. I've not had the courage because I keep on questioning that I feel the market is overvalued. And that is just my very ignorant maybe opinion, but I've kept it. I've not been able to do it. And maybe after this podcast, I'm going to take action and actually do that.
Let me play a devil's advocate on this. There's this big debate on lump sum versus SIP. SIP is a cash flow solution. I have some money coming in regular intervals, I invest. In a way, it's a lump sum of that month's money, right? The moment you convert a lump sum into an SIP or STP or whatever you call, you're actually trying to time the market. And you Google, just one word, should I time the market? You'll probably get 200 pages on why you should not, right? Treat lump sums as lump sums and SIPs as SIPs. Don't confuse the two. Lot of wealth is not created in this confusion. When everybody will tell you time in the market is key, sooner you start better. If you can do it yourself, great. If you can't, there are professionals now who've demonstrated 30 years of track record, 20 years of track record of doing it, right? And then just do your own thing in life and leave it to them.
When you're in a fast growth economy like India, do large caps lose relevance quickly?
Not at all. I mean, here's the thing. Let's look at, and I'll put that 2019 as the benchmark because that's when capitalization was defined by the regulator. Let's look at that. The difference between the smallest large cap and the largest large cap in market cap is 16 times. When people say that, that's where least wealth is created. The difference between the smallest mid cap and the largest mid cap is 3 times. The difference between the smallest small cap and the largest small cap is also 3 times. Again, bringing back to my earlier logic, that is a good cap and a bad cap. There is growth opportunity everywhere. In fact, 16 times is a fairly large journey for a small large cap to become a mid-level large cap. It's actually bigger than many mid-cap journeys, right? So do not go by these cliched statements. There is, in a growing economy, and you compare our large caps to the large caps of the world, will still look mid caps. And if you are looking at an economy which is going from, say, 4 to 8 trillion, these companies will become substantially larger at a lower risk. So when you look at return, if you convert that discussion to risk-adjusted returns, then all these statements will get reviewed.
I would pick on the point of what that 16 times differential, and globally, if you look at the large caps, what are large caps compared to, and you can take the example, or I'll give you a global example, FANG. I am myself astounded. I like pinch myself and say that, look, what is the opportunity? Like Meta, Apple, it's like 2016. Now this iPhone 17 has come up, right? And then the analysts which were saying it's going to be a $200 stock, already giving 30% on Apple market. It's a $1 trillion market cap. And nobody can forecast what's going to happen, but
Yeah, it's part. One stock is part of our portfolio, so I'm not allowed to. One stock is 75% of our market cap, right?
And if you look 10 years back when I invested, I think like I couldn't have imagined. And for where India is and where India is growing, you couldn't probably imagine what your large caps will do. So you have to be across all segments of the market, depending on, obviously large caps would potentially be safer. Right?
Talk FANG, there's a big debate between me and my team. There are fund houses which are opening up for global investing. And you open up because the thing is closed if your fund gets redemption. And I keep on shouting, why are none of our funds opening up? They're saying nobody is redeeming the FANG, right? It's crazy how the FANG has been a learning for most of us. And just when you wrote it off, it takes a different birth.
It's interesting because tech always hogs the limelight. Are there other silent compounders that the smart investors should focus on as well?
See, I think my personal compounder has been closest to my heart has been healthcare. It's a no-brainer for India. I mean, the consciousness of being healthy is just about starting. The number of people who are now converging towards a healthier lifestyle, and rightfully so, is just about beginning. Don't confuse healthcare with pharma. It's just part of healthcare. I mean, think about this whole thing. Now, I decide that I will become a jogger tomorrow morning. Can I jog with any shoe? No, I can't. There's a specific shoe. There's a specific attire. There is a certain earphone. There's a certain appliance in my... They all come together. If I were to cycle, I can't cycle in that old black cycle that was there. There's a certain cycle. And without them, the whole kainat will tell you can't lose weight. Well, you can. But in this creation of health, is a great future for India. For India is actually on that side, whether it's banking. My personal always will remain healthcare because we're just about getting penetrated. And make one statement on that. The increase in penetration of insurance will only increase healthcare, and insurance penetration is beginning to take, with the government supporting, now gone to the last mile. Right? So what can happen in the next 10 years on healthcare is something which you right now cannot think of, but it's a perpetual compounder. I can name others, but since you have asked me one, this is my one.
Sure. Beyond FANG, beyond tech, what are some silent compounders according to you?
So I'll give you a theme. I would say again, I'll come back to maybe disappoint you, but tech infrastructure in India. So some companies might not be listed, or people are, because I think what's happening, and we are realizing that we are dependent on global stacks for tech, right? So for example, UPI and PCI, we built an entire stack ourselves, and which is phenomenal advantage. But in a lot of other spaces, we are not yet at an operating system level, at a more infrastructure level, like including data centers. Like we are on, again, the FANG dominates all the cloud providers. But what about companies that are in India who are building our own cloud? What are companies who are writing operating systems for phones, for general applications, semiconductors? And I think that will be next big wave, and a lot of these companies will then list and then create like phenomenal wealth outside. I mean, we hear a lot about capital related infrastructure like bridges and roads and all. Obviously, that is there. But tech infrastructure, and I think the next sector would be space. So the mostly startups and in the unlisted space, but that is one area, coupled with artificial intelligence, would be phenomenally big for a country like India.
So I'm very curious, how do you then explain to a layman investor of what is thematic sectoral hybrid fund?
Yeah, thank you for asking me that, because a sector is a subset of a theme. Let me go back to the beginning of my career. When we started in the late 90s, our fact sheet used to read banks, bank, NBFC, banks, NBFCs, financials, bank, NBFC, financials, fintech, payments. A theme structurally grows. A sector becomes part of the theme. So most people confuse themselves there. Think of thematics as sectors. No, they're not. Sectors are cyclical. Thematics are perpetual. I mean, look at it. We launched our consumption fund 16 years ago when it was practically FMCG. Today, the consumption fund is a diversified portfolio. When we launched healthcare 5-6 years ago, primarily pharma. Today, it is beginning from hospitals, and the new listings are happening, right? And now we're talking about chemists listing. We will see a lot of fitness companies listing. And then that's where people need to realize that we have a very interesting fund in the US called the Social Media Fund.
Mhm.
The Social Media Fund was launched when Facebook was not there. Think of the thought.
Wow.
The Lithium Fund is probably in its 11th year of. Now look at lithium is now everywhere is lithium. It's just not just one battery company. Now battery companies have become the best car makers of the world, right? So the themes will grow over a period of time, and if you sit on a particular theme, and I leave your viewers back with one homework: pick up any consumption fund you want, any consumption. Check their data points from volatility to returns to any flexi cap they want, and the answer will come there. So globally, nobody invests in market cap products anymore. People look at thematic investing because they will grow perpetually. Look at manufacturing now. We're just about beginning to sow the seeds in manufacturing. If you start getting into a manufacturing theme right now, next 15, 20 years belong to India on the manufacturing. Don't confuse our manufacturing with say China manufacturing. Look at manufacturing from this base to what it will become.
I want to go a little deeper on this because there are investors who would want to sort of put your thought into action. But how do you sort of have that conflict and navigate thought of long-term planning with short-term narratives?
No, short-term narratives, people get carried away, and I don't want to get too much into it. So defense is a sector, right? Don't confuse that with say broad structural themes. Slowly but surely, see, when you form a portfolio, there is a core part of the portfolio, there's a satellite part of the portfolio. Sectors can be on the satellite side because when sectors run, you can get away with some great clean returns. But your risk profile will get a lot of these themes which become very solid and core to the country towards the core too. For me, the four solid themes of India are banking, healthcare, consumption. Yes, infrastructure has flattered to deceive, but with that segment now becoming more and more structured and well governed, the next 10 years infrastructure can look very different from the infrastructure of the past 20, 25 years. The economy will base itself on these four pillars. And if you're looking at India going from 4 trillion to 8 trillion, these four pillars are a no-brainer.
Gaurav, you've seen Southeast Asia markets, you've seen the US market, and now you're obviously in the Indian market. Are there any trends, patterns that you see in themes versus sectors versus hybrid patterns?
Yeah, so I would say again, corroborate what Swarup has said, that sectors are a subset. For example, take defense. Obviously, Operation Sindoor happened, and defense, anything related to defense will go through the roof. But the underlying theme is indigenization. So if you take that as a theme for India, all of it which is coming, made in India, different type of manufacturing, you have to be self-sufficient in something as strategic as defense and space, and even owning your own spectrum. Like one of the important things that I would say that like a lot of the military communication that happened during Operation Sindoor was on something known as NAV-IC, which is our own indigenous spectrum. Versus GPS. Not many people realize that GPS is like global position system, which is controlled by global players. So the point is indigenization. Part of it is defense. Next thing could be semiconductors, for example. A lot of investment, it's still a lot of things to be done on the ground, but that is coming because we want to be self-sufficient chips. Tech infrastructure, as I said, like own data centers, own layers. Why do you think TikTok is such a hot button issue in the US? Is exactly the fact that like they can actually everyone's using a TikTok, so like you can actually spoof on American citizens, and
we think Insta is big, we don't know what TikTok is.
Exactly. Exactly. So I think you have to treat sectors in the context of a larger theme. For larger themes in India, I think I completely agree. Consumption is one, obviously is going through the roof. It will increase. Urbanization, this whole talk of tier 3, tier 4 towns. Massive urbanization. Tier 2 is already a done story. We are now talking like maybe even tier 4 and beyond, like very small cities, pin codes you won't have heard of. And they are like, there's real estate coming in, there is infrastructure happening. Education is one. Although from a monetization perspective, to figure out what is the right model for India, but education is big, aided by tech, AI. Healthcare is another one. And then infrastructure and banking, because banking also, if you can consider, is the infrastructure, financial infrastructure of the country. So if you treat that as a theme and take it for next 10, 15 years, some sectors will come, some sectors will fall out of favor, and some sectors will continue to be consistent performers again. But it's best left to people who are best in the business and do this day in day out to figure out which companies and which sectors at what time need to come in, right? Rather than you figuring it out. You have to be a research analyst and talking to like hundreds of founders and hundreds of companies to track a sector and be on top of it.
Yeah, the other part was the hybrids, and I think that's where a lot of investors need to. I went through a proper unlearning on the multi-asset. I mean, hybrids essentially invest across asset classes. Typically, earlier it was equity and debt, but the multi-asset got in the commodity side. And what was very interesting for me to learn from data is that a multi-asset, the probability of getting median return over a period of time is higher in a multi-asset than a single asset. I mean, a multi-asset's probability of giving you a median return is higher than equity. That was unheard of for me, and just brings out the virtues of asset allocation. Now, if you allow me to make a confession, what was wrong with me? If I would have said that equity is a growth asset class, nothing is wrong. What I said was equity is the only growth asset. Now, on a 10-year horizon, when gold is outperforming equity, I don't know where to hide. Right? So that's where these multi-assets become very important. The only caveat I'd like to leave behind is a lot of people believe that a hybrid fund is their answer to asset allocation. That is fundamentally flawed. A hybrid fund will allocate as per the fund's desire. If you treat it as your asset allocation, then you are changing your asset allocation to the fund. The fund should be bought on the merit of its risk profile rather than an asset allocation tool.
Let's say I'm a first-time investor in the bracket of 25 to 35. Picking on your point, how should I then approach asset allocation? How should I look at it? And we don't want like a financial jargon perspective, but let's say really breaking it down from a layman perspective.
Yeah, I think first of all, I mean, my fundamental request to everybody or to you would be, ask yourself this very powerful question: why do you want to invest? If you don't have an answer, then let it remain in the bank. Okay, don't invest. Because if you don't have an answer to that why, you will invariably not know where to invest. Right? So ask yourself, and everybody's why is different. Gaurav has a different life stage, life goal. My life is very different. Your life is very different. Once you have an answer to the why, you'll probably know, okay, in this many years or this many months, you want this much of money. That's your first check that whether that money is feasible or not in that money. Because from that will come your basic return generation requirement. If your return generation requirement is 6%, keep it in the bank. Now, if your return generation is 30%, in Mumbai, then we say you take an Uber, go to a very good place called Mahalakshmi Racecourse and put your money on horses, because those returns are not feasible. So, one is to know the realistic way to invest. That's why a plan is very important, right? And there are two ways of plan or a goal or whatever you call it. Now, two parts to it. One, you form a goal. From there comes your investment universe, which we call it asset allocation. Once forming that is the easiest. From there comes the product. Invariably, you make the product the hero. The product is not the hero. The product is a means to reaching your end. You want to make me, the asset manager, the hero, I will be the hero. But I am not the hero. I am stage 4. There is talk of risk profile. We discussed that risk profile is knowing yourself over a period of time. It will change. So your portfolio will change accordingly. But these are most important part. After putting that place comes the most important part called review and rebalance. If you are on track, then you are on track. If you are not, then you kind of change. This is where I feel like we talked about small caps, the need of a good advisor comes in place. Because more than giving you the plan, I think a good advisor or a distributor keeps you on track. I always say that a star in a person's life is the goal, but the rock star is the person who takes you to that goal. So the need for a professional advisor distributor is also important. It's a very simple process. Don't go just for the product. Sometimes people ask me, which is your best product? When I ask you, why do you need my best product? They get a little surprised. Because our best product may not be suited for you.
True.
Right? Like there's a proper medicine for everything, there's a fund for everybody. But you have to know which fund sort of agrees with you. But if you don't want to do that and go to the cliched sort of thing, then break it up into very simple debt, equity, People say age, but now people are living longer. So don't make it 100, make it 110 minus your age. So equity, which is the growth asset class, again I stand clarified, equity and probably commodities there, and the safer asset called debt on the other side, and keep it like that. So as you grow older, you tend to keep your safer assets more. But even at 80, your growth assets are 20 or 30. So if you want to simplify that, do that and follow it. But every year, check your portfolio.
Interesting. Gaurav, how should one look at asset allocation?
So I'll give you a more execution-oriented answer on this. So first is invest in yourself before you invest in any financial security. Right? Work very hard, make some money, and don't blow it all. Keep something to invest. So that's where you even think of, let's say, when I was in my 20s, I was blowing away all my money, so I couldn't even think of investing. So keep some aside, and then invest. So even though you may not understand like concepts of asset allocation, it's a completely newbie, right? Kya karna hai? Buy an index fund, and then see how it grows, how it performs, and all. That will give you at least get you started before you reach the stage of having a financial advisor or thinking about it. Your asset allocation will evenly balance itself, because I mean, practically speaking, for most people, it is like you have some money in the bank which you don't need, right? And then that stays in the bank, so that becomes your fixed income in terms of FDs, right? So you're not putting in debt funds and all. So asset allocation अपने आप होना शुरू हो जाएगा. So take that first step, and after you've done that, you will see that will give you like I would say the muscle to then increase and start to take a little bit more risk, understand the market, and so on and so forth. But at a broader level, I would say, obviously, if you're in 25 to 35, you should be overweighted on equities, especially if you're an Indian investor investing in the Indian markets. That's the way to go, and you can figure out hybrid, thematic, small cap, mid cap. That will all figure out by itself. As far as other asset classes are concerned, obviously real estate, gold, there are ways you can take exposure to it. But I think the biggest problem is we do not take the first step. You have to take the first step. Take it in a direction where you feel safe. So index fund, you can feel safe, and then see how it goes. Rebalance, as Swarup said. Review it over a period of time, at least yearly, and then I think that will just get.
So let's add a fundamental rule to all your money. The fundamental rule to all your money is all your money should be beating inflation at all points of time. If you start with that realization, rest will come in. You have to find place where it is growing above inflation. Otherwise, it's eating your money.
This feels like a natural segue to my next question, and this question will have two parts: life and finance. So, what has been the most incredible advice that you've received for money and on life?
I think that's the advice which Gaurav said, put aside some money to invest.
What you have received?
That's what my mom said, but I didn't listen to her in the beginning of my life. I blew it up. So the pressure on me to invest now is substantially higher than what it would have been if I had invested early. That mistake I'm not repeating with my son. So initially it was a fight with him, but now he's seeing some money compounding, so he's okay now.
Interesting. Yeah. And what's the life advice that you've carried with you?
I think 2-3 life advices. One, I think from a professional perspective, an ex-boss of mine said, I'll leave you on his date of retirement. He said, 4 words तेरे को छोड़ के जाता हूँ. Read more, meet more. And this is very early in our lives. Our parents and our principal have taught us, and be trustable. And luckily we do a job, a fiduciary job, which is a business of trust. So we don't deviate from the law. And if you keep that intact and lead a life within the framework of law, a lot can happen.
Yeah, so I know 2 parts of the question: money and life. So on money, I kind of learned from my dad. So he had some, at that time, I think back in like late 80s, early 90s, some used to have these physical forms, right? So he actually had taken some bonds or something, some NBFC, which was giving like 21% return. And that happened, I think around 96, 97 that happened. And there were a lot of NBFCs who were doing that. So he took it, and then as a collateral, they gave some nice share certificates, some Bajaj and ITC and so on and so forth. And my dad being my dad, once, returned all of that collateral when the NBC went down. And those shares, when he told me what the shares were and what they've compounded in the last 30 years, I said, wow. So lesson number 1 was he didn't give me directly, but looking at his experience, I had like, if only we had held it, the compounding would have been great. So first is, you start investing. Life lesson, again from my dad, is like, stay the course. try to do things for the longer term. And it starts with your whatever you're doing professionally, whether you're a founder, whether you're running a company, or if you do things for the long term, typically that's where the returns come. And obviously, that's not intended to say my next statement that stay the course in investing as well. So.
The 70-30 rule, equity debt, does it still hold relevance in 2025?
No, I think a lot has changed at the underlying. Please understand, in the last 2-3 years, what we call the democratization of the market, a lot of public issuances rightfully are coming to the market, and hence the nature of mid and small cap is changing, number one. Number two, you're living longer, right? And then more than 70-30, you have to be cognizant of your lifestyle inflation. When you put all that at an early stage of your life, maybe you have to push more than 70, push more towards mid and small, because that place is getting far more structured than it was, say, 5 years ago. So with the dramatic change in underlying and with this geopolitical nature of the world remaining, I think some amount of importance to the ownership of commodities in the form of investing is something one has to sort of think of. No longer can the commodity be treated as a hedge, is my unlearning process which is going on right now. So most of the rules are changing. The sooner you imbibe that in your portfolio, better for you.
Yeah, so I would say that lifespans are increasing. So what I typically call industry is longevity risk, right? So 70-30, not sure if that would hold going forward. I mean, obviously, if you're going to live much longer, which is a good thing, but then you also need money, right? So your allocation has to reflect that. Has to reflect that at every stage, whether you are 75, 80, or going beyond that. I think the commodities point that you mentioned is also relevant, because a lot of things are changing across the world. So you have to be cognizant of the fact that what is owned, what is with yourself, where is it custodied, etc., etc. So again, I'll come back to the earlier point that you still, in spite of everything, you need to have some cushion that you can lean into when the lights go off or there's a bomb falling. You have that money, right? And that could be with a bank, that could be whichever you want. That is the only comfort that you will have, rather than kind of losing your shirt. So once you have that, then you have to look at your longevity risk, and you have to look at it.
One part is whether it's good for men or not. It's definitely good for women, because women live longer than men, and women will need more money than men in their entire life. So women need to think harder than men.
What a great note. This one question that I'm about to ask is a question that I ask in every episode. What's your bold prediction with India's mutual fund space by 2030?
So we haven't seen anything yet. I think the financial penetration is just about increasing. At our end, we have to think of building capacities, because that's what it boils down to. Yes, money will come. We should be ready to deploy and do justice to the money. So last year, when I'd said SIP book at 25,000, nobody had believed me. This year end, I had predicted 40, and I'd said I might be off by 5,000. Yes, we're almost 30,000 crores. This country is now beginning to invest in financial assets. So the 78 lakh crores will go where is unthinkable. But only thing that I predict is the composition of the assets in the form of mutual funds and passives will be very different. I mean, I dare say that a lot of newcomers will start owning the index first. And when that happens, I think the composition of the split between active and passive will be very different.
Gaurav, what's your take?
So I think mutual funds, it's just the start. So it could easily double from here in the next 5 years. That is one. Second, on the active and passive part, like we'll give you a data point. I think I was reading it today. Back in the 90s, so the first fund started in 1976, I believe, or somewhere in that, when Vanguard started this whole concept of passive investing. And then fast forward to the 90s, it was like some millions of dollars. Today it is, I think, 1.7 trillion or some crazy number like that. And 33% of all of the mutual fund space globally is in passive funds. And you can imagine what that pie is. So point I'm making is that no one can predict, and we do not understand how scale multiplies very, very quickly. That's 16x multiple. So given all the fundamentals are in place and increasing financialization, demographic dividend, etc., we don't know where it will go. So
when you started, you lead your entire life reading Warren Buffett, and then comes John Bogle. And Bogle starts his book by saying that how can you plan your long-term investing with active mutual funds? They may or may not be there. The only constant is the index. So all your long-term money should be with the index. And then when Warren Buffett says, after I retire, invest my money in S&P 500, you start thinking that, it can be a very different world going forward.
Wow, this has been such an incredible conversation. Thank you, Swarup. Thank you, Gaurav. Thank you for all your perspectives, extremely candid. With that being said, I hope you've had some takeaway, because for me, the important takeaway was stay invested. I'll see you in the next episode. Until then, stay curious, stay patient, and stay invested.